Hey everyone, and welcome. Today, we are diving deep into something that sounds a bit dry, but I promise you it's where the real money is made. We're talking about the incredible financial power of patents. It's an idea on paper that can unlock billions, and we're about to find out exactly how.
So let's start with a question that sounds kind of crazy, right? How can an invisible idea, something you literally can't see or touch, be worth more than a giant factory filled with tons of expensive machinery? Well, that's the puzzle we're going to solve. And the answer, well, it gets to the very heart of how modern business really works.
And here it is. This is the key. When a Wall Street analyst looks at a company's patents, they're not really seeing some cool invention. No, they're seeing protection. They're asking, how safe is this company's income stream for the years to come? And you better believe, in the world of investing, that kind of guarantee is everything. Okay, so let's break this down with our first key concept. A patent, or any kind of proprietary tech, isn't just a clever idea. On paper, it's what's called an intangible asset. And that means it actually gets listed right on the company's balance sheet, right alongside things like cash in the bank or the headquarters building. It has a very real, very specific monetary value. And we're not talking pocket change here. I mean, think about a big pharmaceutical company. The patent for a single successful drug can be worth billions, with a B. In many cases, it's the most valuable thing the company owns, worth more than all their shiny labs and corporate offices put together.
So what does this patent protection actually give you? Well, it's essentially a 20-year legal shield. Think about that for a second. For 2 whole decades, nobody else is legally allowed to make, use, or sell your invention. That total lack of competition, that's where the financial magic really starts to happen.
And here's a perfect real-world example. Apple. Because of their design patents, no one can just go and make a phone that looks and feels exactly like an iPhone. That means less competition, which gives Apple the power to charge a premium price and maintain these huge profit margins. We're talking over 40%. That is pure pricing power, all thanks to its patents. This brings us to a really powerful idea that the legendary investor Warren Buffett talks about all the time, the competitive moat. Just picture a company as a castle. The moat is whatever protects that castle from invaders, or, in business, from competitors. It's the barrier that keeps them out and keeps the profits safe inside. So, you see, a portfolio of strong patents creates a really wide and deep moat around a company's profits. For an investor, that's a huge green flag. It signals that the company's future earnings are safe and predictable. And what do investors always pay a premium for? You guessed it, safety and predictability. That translates directly into a higher valuation for the company. But there's a catch. That 20-year shield doesn't last forever. And that leads us to the single biggest threat for these kinds of companies, something called the patent cliff. This is that terrifying moment when a key patent expires and that big, beautiful moat just evaporates. Now, just to give you an idea of how dramatic this can be, look at this number. -80%. Wow, what on earth could possibly drop that much that fast? That's how much a company's revenue can plummet, practically overnight. The second the patent expires, generic competitors flood the market. Prices crash, and that income stream that was once a raging river can shrink to a tiny trickle in no time. And believe me, this isn't just some textbook theory. It's very real. Just look at Pfizer's blockbuster cholesterol drug, Lipitor. The day its patent expired, the floodgates opened. The company ended up losing $10 billion in sales per year. That, my friends, is the patent cliff in action. Okay, but there's another much cleverer way to play the patent game. Instead of just protecting your own product, you can actually license your technology to other companies, yep, even your competitors, and then just sit back and collect the royalty checks. It's a fantastic, high-margin way to make money. And the undisputed king of this strategy is Qualcomm. These guys are geniuses. They invent and patent the core technologies that make our smartphones work. Then they license those patents to basically every company that makes a phone. They rake in billions, and they don't even have to manufacture a single handset themselves. It's an incredible business model. So let's pull all these threads together now. As you can see, having a strong patent portfolio sends a powerful ripple effect through a company's entire financial picture. It shores up revenue, it boosts gross margins, it pumps up the valuation, and makes cash flow way more predictable. And, maybe most importantly for an investor, it significantly lowers the company's overall risk profile. And this, right here, is why it all matters so much. This isn't just some academic exercise. This kind of patent analysis is the bedrock that justifies the complex financial models analysts build. It's what underpins buy ratings in their research reports, multi-billion-dollar merger deals, and even the credit ratings a company gets. It's the foundation of financial confidence.
So really, it all boils down to this one simple, powerful chain reaction. You start with strong patents. That gives you a temporary legal monopoly. That monopoly allows for premium pricing. Premium pricing leads to higher profits. And higher, more predictable profits always lead to a higher valuation. That's it. That's the whole game right there. So the next time you're looking at a company, don't just get dazzled by its flashy products or big factories. Ask yourself the real billion-dollar question. How wide is its moat? Thank you so much for watching, friends. And hey, before you click away, do me a favor and leave a comment below. Let me know which stock or which sector you'd like to see me break down next. I promise I read every single one of your comments. Here on your analyzer, we don't just talk about stocks, we actually explain and teach every single fundamental concept in detail so that you have the tools to analyze companies yourself. So for more of this kind of deep learning and market insight, go ahead and subscribe to the channel right now, and don't forget to hit that bell icon so you don't miss a thing. Thanks again for watching, and I'll see you in the next one.
Disclaimer. Educational content only. Not SEBI registered. This is not a buy/sell recommendation. Invest at your own risk.